Does this say this is live? This streaming software is not working right. They upgraded again and made a bunch of mistakes. It's supposed to say, oh, anyways, people are going to complain, whatever. Okay, so more mainstream businesses are going bankrupt in the last couple days. Meanwhile, as predictable, the U.S. general stock market indexes are rising. But in the last couple days, we've had the California Pizza Kitchen, which is mediocre, casual sit-down dining at a lot of malls. It's the anchor store of a lot of malls, or at least it used to be. And they also have a pretty good business for selling frozen pizzas in the grocery store. I imagine that was doing pretty well, although the sit-down restaurants for California Pizza Kitchen in the malls probably are doing horribly. And in the last 24 hours, we've had the parent company for the Men's Warehouse, which is a, like, I would say lower middle class suit company, Joseph A. Bank, owner Tailored Brands, and Joseph A. Bank, owner Tailored Brands, filed Chapter 11 bankruptcies, and I think Lord & Taylor filed for bankruptcy today too. So a lot of bankruptcies out there. So this show is going to be an update on the commercial real estate market. We had Charles Gasparino, who was, I think he was the main editor for CNBC for many years, and then I think he switched over to Fox Business now, and he's gotten in a lot of fights with people, with Donald Trump and others. But he wrote an op-ed a couple days ago on August 2nd, why looking at the stock market won't give you a full picture of the U.S. economy. Between the federal government and the Federal Reserve, around $10 trillion has been pumped into the U.S. economy to prevent a pandemic-fueled economic collapse. Judging by the stock market, you would think we've sidestepped a 2008-style disaster, but stocks, at least in the short run, are rarely a good indication of what's festering inside the U.S. economy. And let me add here, because people say, oh, you only read the articles, you don't do any analysis. This is garbage. This is boring. The main reason is the central banks, in terms of emergency liquidity injections and fiscal stimulus from governments, when you combine those, tens of trillions have been injected since the end of February and early March. Well over 23 trillion has been injected. Although if you believe the Fed's official balance sheet, they've been pulling out about a little over 200 billion. Not sure I believe that. Although the dollar index looks like it may have bottomed temporarily. It's rallying a little bit. We'll see if the rally lasts. My Patreon account contributors saw that for chart analysis for the dollar index, that there actually was support levels in the 92 and 93 range, also 91, before the dollar index really started having big problems. And just like what's festering inside the U.S. economy, a better oracle is certain aspects of the bond market, particularly those that are tied to real estate. And just like in the prelude to the 2008 financial crisis, when the stock market was at all-time highs, this particular market is signaling a warning sign that the economy is heading for trouble. In 2008, the canary in the coal mine was declining residential real estate prices, that failed to catch the attention of most market participants before it was too late because of a number of factors, including Fed easing. And then, sound familiar, also it was the subprime. So the subprime defaults, the subprime mortgage-backed securities, those things were sounding the warning. And then you had the Federal Reserve come out and lie, Ben Bernanke come out and lie, Alan Greenspan before he left and got out, before everything collapsed, lie that subprime was contained, real estate prices never go down, all the lies. Jim Cramer was lying too. Jim Cramer, who blocked me on Twitter, and I've never even spoken to him. Probably saw some of those pictures, fan art that some of my listeners sent in with Cramer the Clown. So he blocked me on Twitter too. Him, Marin Katusa, and now Thomas Thornton, who was bragging on his Twitter a month ago that gold and silver were the easiest shorts. He actually said a month ago on his Twitter, Thomas Thornton of Hedge Fund Telemetry, that gold was an easy short. I think maybe even slam dunk short. So he had an Ask Me Anything a couple days ago, and all I asked him for his Ask Me Anything was, are you still short gold? And 10 minutes later, he blocked me. Now a similar, and that's not even really trolling that hard, now a similar tumult is beginning to infect the commercial real estate market. Delinquencies and defaults are rising on the mortgages of malls, high-rises, and office buildings. Traders in this market tell me. It's easy to see why. In New York City, will the much heralded Hudson Yards complex ever reopen? Millions of upper-income New Yorkers are fleeing the city, not just because of the pandemic, but also because of rising disorder, and they voted for crazy Democrat politicians who tax them up the wazoo and are taking away now, took away their gun rights and taking away the police so they can't protect their own property. Good job, rich Democrats, rich champagne socialists who voted for this nonsense and are now fleeing. It's easy to see why in New York City will the much heralded Hudson Yards complex ever reopen. Okay, I already read that part. And who wants to shop in a mall when you need to get your temperature checked every time you walk into a store? It's not just a New York phenomenon. Does anyone really want to work in downtown Portland, Seattle, or San Francisco anytime soon? The underpinnings of the commercial real estate market, an estimated $16 trillion business here in the U.S., have begun to turn significantly negative, posing an economic, systemic risk to the U.S. economy. Also to banks like Wells Fargo Bank, which a lot of financial professionals will not talk about in public, has the largest commercial real estate loan book of well over $1 trillion, which might explain why since February 10th, when the pandemic really started to get crazy here in the US, Wells Fargo Bank stock dropped from $40.22 a share down to right now $24.29 a share, a little over a 50% drop, give or take. And I think it's probably going to get worse than that. If you believe the article that Frank Partnoy wrote about the looming bank collapse, he featured Wells Fargo in there heavily. That's a free article from The Atlantic. I've talked about it many times. You should go back and read it. A lot of people on Wall Street are calling him a liar, even though he worked on Wall Street for many years, left Wall Street to go write financial books and be a law professor. I believe he also helped design some of these derivatives in the 1990s. So he's not someone who he's not an insider. He is an insider. Although not recently, it sounds like. But he is an insider because he helped design some of these derivatives. Okay, let's get back to the article. You won't hear any of that from the industry's cheerleaders who are paid to follow the mantra that the business will bounce back when the pandemic recedes. People will slowly return to work in high-density cities and will continue to attract the world's best and brightest once cultural activities are reopened and the cities can return to normal. All of which may be true in the long run, but as Keynes put it, quote, "In the long run, we are all dead." The only way to tell what's happening in the near term, which could last years, is to look at what's happening in commercial real estate securities. Their prices are declining, a reflection of real trouble to come. And look at all I mentioned just a couple bricks and mortar retailers and restaurants that just filed for bankruptcy just in the last couple days. But there are not only bankruptcies, there are an enormous amount of store closures here that are already announced and planned. According to Goldman Sachs Global Investment Research, I do not have room to put the chart on the slide presentation here. If I was going to do a short video, maybe I'll do a separate short video and put this slide presentation, or I'll put it for patrons. But there's a lot of stores closing, a lot of retail stores that are closing enormous amounts of stores here. It's a long, long list, which means that whoever's holding those commercial real estate mortgage-backed securities or whoever was a commercial real estate investor is probably looking at a big haircut. Now, maybe for the last couple months, they thought things would turn around or come back at some point. It's not looking that way. Of course, predicting the next financial crisis is more often than not a fool's game because, let me add this part here. Here's some analysis here for the person who says, all you do is read the articles. Here's some analysis here. Because predicting the next financial crisis is more often than not a fool's game. Why is it a fool's game? Because most people don't understand how often the politicians, the bureaucrats, the central bankers are changing the rules behind the scenes. All the bailouts they're doing. How in March of 2009, they changed the accounting rules so the banks didn't look bankrupt, so the stock market could rally, so the banks could start making loans again. Again, it's all about, at this point, all that is left is bailouts and rules changes. So how's that for just reading the articles? The only way to tell what's happening in there, I can't tell, here we go. I can't tell you how many, quote, Lehman moments have been declared by market-wise men, suggesting that a certain set of factors were in place to spark a bank collapse and then a broader decline in the economy. Yeah, rationally, there should have been more Lehman Brothers moments, and maybe HSBC Bank, and maybe Wells Fargo, maybe there will be problems. Or maybe the stocks will just go a little bit lower, and then the Fed or these other central banks will magically come in with more rules changes and bailouts, and probably not even tell us, unless they have to issue a bunch of press releases to assure everyone that there's currency swap backstops to plug the holes. Yes, the banks may be capitalized now, better capitalized now, and perhaps unlike in 2008, they aren't holding as many real estate loans on their books. Maybe New York's political leaders will open the city up and help save the commercial real estate market and the economy with it. But those are all big bets and ones that more and more smart people aren't willing to take. Okay, why Goldman Sachs is a target. Goldman Sachs has long been known for its big clients, big bonuses, reputation as a premier bank for merger and acquisition, but lately it has also become known for speculation that it's takeover bait. Who's going to take over Goldman Sachs? That's kind of ridiculous, unless they need to be bailed out. Okay, the rest of the article is not about commercial real estate. We'll skip now to the second commercial real estate article here, which I have part of it on your screen, the Wolf Richter article from July 24th. Wolf Richter of WallStreet.com does a great job with a lot of research for free. He also has a YouTube channel with some short little podcasts, but his articles are very in-depth. So this article is bricks and mortar retailers, malls, mall real estate investment trusts or REITs and their debts. The whole schmear, if you don't know what a schmear is, that's the spread that goes on top of a bagel, is coming apart. There's just no way out. The only thing that is surprising is how long these retailers and malls, which have been spiraling down for years, were able to hold on. That's because they had some cash flow. That's because the loan problems that these retail companies had, there was a lot of leveraged loans, there was collateralized loan obligations, and there was rolling over of loans. So new debt was issued at different terms, and payment and the total amount of debt and the payments, the debt being due was extended into the many years. But now that there's a cash flow problem, now the tide is going out, and we find out who is naked when the tide is swimming. Well, I screwed that one up. We find out who is swimming naked when the tide goes out. We also find out all the fraud. So when the tide goes out, when there's not cash flow, that's how we found out the Bernie Madoff Ponzi scam, because a lot of people tried to redeem their investments in Bernie Madoff's investment Ponzi. Well, they didn't know it was a Ponzi at the time, but people thought they had profitable investments in Bernie Madoff's Ponzi scheme, and they tried to pull their money out because they had so many losing trades and losing investments elsewhere. So when things get bad, that's when you find out where the majority of the fraud is. That's when you find out where the majority of the waste, fraud, corruption, and abuse and excesses in the economy are. See, the Wolf Street, he came up with his own index, market cap weighted stock index of 11 mall real estate investment trusts, made a heroic effort to bounce off the crisis lows and was able to double in 3 months, but has by now given up much of it, and it appears to be heading back to crisis lows. The index includes Simon Property Group, Tanger Factory Outlet Centers, Taubman Centers, Cedar Realty Trust, Macerich, Seritage Growth Properties, Kimco Realty, RPT Realty, Washington Prime Group, Brixmore Property Group, and CBL, which is preparing to file for bankruptcy. Also, pension funds have an enormous amount of commercial real estate investments too. After Friday's 2.2% drop, the index is down 74% from August 2016 when the big skid started. And from the heroic spike that topped out on June 8th, it has now plunged 35%. The chart is ugly. I don't have that chart up on the screen for you to see, but take a look at it in the article later, which will be below the video in the information and description section. What will be left when the bricks and mortar meltdown is over? The process started years ago. E-commerce, a structural shift in how Americans shopped, has wiped out retailer after retailer. From big ones, so has raising the minimum wage when so many of these bricks and mortar retailers or restaurants were barely getting by. Has wiped out retailer after retailer, from big ones such as Sears Holdings and Toys R Us to smaller ones. It created a nightmare scenario for malls and landlords, including real estate investment trusts that own the malls, and for investors that hold the mortgages and the commercial mortgage commercial real estate mortgage-backed securities, or CMBS, that these mortgages have been packaged into. And now that the pandemic is compressing future years of bricks and mortar meltdown into a few months, the whole schmear is coming apart. Asena, the latest in the pandemic series. The latest mega retailer that filed for bankruptcy and announced large-scale store closings was Asena Group, which operated about 3,500 stores last year, but after closing all of its 661 Dress Barn stores in December, it's now down to 2,800 stores. Its 7 surviving brands are Ann Taylor, Loft, Lou & Gray, Lane Bryant, Kashik, I think I got that okay. Catherine's and Justice. As part of its bankruptcy restructuring, it will close about 1,600 stores, beginning initially with 1,100 stores, including all its 264 Catherine stores, most Justice stores, plus some Ann Taylor, Loft, Lane Bryant, and Lewin Gray stores. Asena Group has hired a liquidator, SB360 Capital Partner, sounds like a private equity group, and the going out of business sales are commencing at these stores. They've hired vultures. In other words, Asena had 3,500 stores a year ago and plans to emerge from bankruptcy with only 1,200 stores. The mall landlords end up holding the bag. Bankruptcy fears have dodged, and so they're going to be in trouble too. Bankruptcy fears have, hopefully it's not pension funds, but it probably is. Bankruptcy fears have dogged Asena for over a year. In June last year, as it was getting hammered by the regular run-of-the-mill brick-and-mortar meltdown in effect at the same time, and with cash running low, it announced that it would close all its Dress Barn stores. In August last year of 2019, it emerged that its lenders, fearing a bankruptcy filing, began to prepare for it. Those fears were exacerbated last fall when Asena tried to raise funds by selling two of its mediocre, moribund brands, Catherine's and Lane Bryant, but failed to find takers. The pandemic just finalized the bankruptcy. So it was already in trouble, and the pandemic took away the cash flow and just accelerated the bankruptcy because the cash flow was allowing these retailers and the restaurants that had bad balance sheets, that had too much debt, to keep making payments, to roll over loans, the games that some of these corporations can play, to go and get creative financing from leverage loans or some of these other creative financing that they should not have gotten. And these companies, bricks and mortar retailers and restaurants were getting for the last few years prior to the pandemic, over the last 6 months. In May, when the company began reopening its stores after the lockdown, it became clear that it was over. Traffic to those stores was way down from the already miserably low levels last year. The company said in its update, and cash flow has been, quote, significantly reduced. Yeah, that's being kind. It's probably down over 70%. I haven't looked at the financials. This is a prepackaged bankruptcy filing where lenders have agreed to swap about $1 billion in debt for shares in the restructured company to emerge from bankruptcy. So it is a debt for equity swap, a prepackaged bankruptcy. In terms of there's different types of bankruptcies. So there's a restructuring and then there's a liquidation. In terms of liabilities, Asena listed $3 billion, which makes it the third largest bankruptcy in the pandemic series, behind JCPenney at $8 billion and Neiman Marcus at $5.5 billion. And those other companies were rated by private equity and stuffed with debt over the last 6 or 7 years. They were taken private and by private equity. The vultures pick the assets clean. It's called asset stripping. They use the carried interest, so they don't have to pay taxes on the profits. So it's a nice scheme that the private equity guys have going, and they even lobbied Congress to make sure they kept it. Among the biggest names that have also filed for bankruptcy during the pandemic series are J.Crew, Stage Stores, GNC, RTW Retail Wins, Brooks Brothers, Sur La Table, and Pier 1 Imports. Jostling for positions to be next in line is Tailored Brands, a holding company. Okay, so this article came out on July 24th, so here we are about 10 days later, and Tailored Brands just filed for bankruptcy last night. Holding company for Men's Warehouse, Joseph A. Bank, and other brands. On June 10th, it confirmed in an SEC disclosure it may have to file for bankruptcy. Each one of these bankruptcy filings entails massive numbers of store closings or the liquidation of the entire company or brand. But e-commerce is booming. Americans are spending their unemployment and stimulus money, and they're buying lots of stuff. They're just not buying it at the bricks and mortar store. They're buying it at grocery stores, not the bricks and mortar retail store. The e-commerce announcements by various retailers, those that have vibrant e-commerce businesses, have been stunning. For example, Best Buy said in an update a few days ago that quarter to date through July 18th, online sales have surged 255%. Wow, that's impressive actually for Best Buy. 255% online sales surge. Compared to the same period last year, the Commerce Department will release second quarter e-commerce data in early August, and it will be stunning, but the business at malls is dead. Mall mortgages are collapsing, with thousands of stores being shuttered permanently, and with other stores that haven't been shuttered yet, unwilling or unable to pay rent, malls have been pushed to the brink. The Mall of America, the largest mall in the U.S., is now over 90 days past due on a $1.4 billion loan that has been packaged into a single commercial real estate mortgage-backed security. This is the largest mall mortgage to be 90 days past due, according to TREP, which tracks securitized mortgages for institutional clients. Among the other large mall mortgages that are now 90 days past due is the $218 million loan backed by the 1.8 million square foot Crossgates Mall in Westmere, a suburb of Albany, New York, so that's upstate New York. This loan has been cut into slices and spread over 3 different commercial real estate mortgage-backed securities. Other mall, and I wonder who bought the commercial real estate mortgage-backed securities. Was it Japanese banks? Was it insurance companies? Was it pension funds? Other mall mortgages that are 90 days past due include, and what happens when those commercial real estate mortgage-backed securities go bust? Or is the Federal Reserve just going to print more fiat dollars or digital fiat dollars and just pay 100 cents on the dollar? And that'll be a de facto kind of a mini bailout then for whoever bought that garbage, that toxic sausage. Other mall mortgages that are 90 days past due include the $139 million loan backed by the again, that would be another rules change, bailout and rules changes. Nice little combination there. Other mall mortgages that are 90 days past due include the $139 million loan backed by the 691,325 square foot Poughkeepsie Galleria in Poughkeepsie, New York, which is split across 2 commercial real estate mortgage-backed securities. The delinquency rate for retail property commercial real estate mortgage-backed securities spiked to over 18% in June. And you have the chart there on your screen. That is a big spike. And you know what? When I see a lot of interviews on TV from banking analysts, from Wall Street experts, and they're asked what they are worried about the most, normally on most of the responses, the first 3 words or so, 2 or 3 words, are either real estate or commercial real estate. That's normally what most of the experts are worried about next, that they think is the next shoe to drop. And I don't think the Fed can paper over all of this completely, because you have actual businesses that have decided they don't want to pay lease, that are actually doing okay in all this, that have decided they don't need the office space, they don't want to pay rent, or they want to cancel their leases, or they want less commercial office space. And so all those cash flows that those mortgages for the commercial real estate were leveraged up on, they're based on cash flow projections. Those cash flows have dried up. Okay, CBL Property Group, a mall real estate investment trust with over 100 malls in 26 states and over $3 billion in debt, already issued a going concern warning, which is potential bankruptcy. On June 5th, after it failed to make an interest payment on June 1st, it then entered into a forbearance agreement with its creditors and its discussions to restructure the debt. On July 17th, almost done with the article, on July 17th, Bloomberg reported that CBL was preparing to file for bankruptcy and that it was in negotiations with its lenders over a restructuring agreement with which to enter the Chapter 11 filing. On July 22nd, when the forbearance agreement expired and there was still no agreement, CBL disclosed that it was able to extend the forbearance period and that negotiations continued. Mall creditors are not amused. Mall properties have taken a huge hit in value. They are down over 33% over the last 12 months and down nearly 50% over the past 3 years, according to Green Street Property Price Index. I've never heard of it, but he has a link to it. Wolf Richter has a link to it in the article. And no lender wants to end up with a bunch of zombie malls on their books, but that's what's happening unless Jeff Bezos and Amazon decide to buy the mall for pennies on the dollar and turn it into an Amazon distribution center, an Amazon warehouse, which has actually been happening for the last 5 or 6 years. The Wall Street Journal has videos on this on their YouTube channel if you want to see this. So Jeff Bezos, because it's right near a lot of residential areas, he's been buying up shopping malls for literally pennies on the dollar out of bankruptcy and turning them into Amazon distribution centers. So Amazon is one of the big winners in this. So is Walmart. Walmart's killing it on online sales now. And no lender wants to, I'll just reread this again because it's the last sentence, and no lender wants to end up with a bunch of zombie malls on their books, so they're motivated to talk, but there is just no way out. Unless the Fed comes up with a new bailout scheme and more rules changes, and the government does too, that we haven't figured out. Maybe Congress will do some of those tax credits that the U.S. home builders got to help bail them out, and why all the home builders didn't all go bankrupt in 2009. Please click, tap, or smash the like button if you like the content so far. I have a number of other commercial real estate articles here. If you want to read them after the live stream show is over, they will be in the below this video in the commercial information and description section. Tourism's collapse could trigger the next stage of the crisis. The next big problem for the economy, businesses can't pay their rent. And then if you want to read about the bankruptcies, the recent ones with California Pizza Kitchen and the parent company that owns Joseph A. Bank and Men's Warehouse. What a mess. Meanwhile, like I said, the U.S. general stock market indexes, we have the Dow futures well over 26,000, the S&P futures well over 3,000, the Nasdaq's even over 11,000. And the Russell 2000 futures are over 1,500. But the gold price is close to 2,000. So at least maybe the gold price is starting to tell more of the truth. Or the paper price manipulation is not working as much. Or more people are buying the dip. Or it's a combination of those things. Yeah, I apologize for this new live stream show software on YouTube. It did not say hit the button to go live. It just turned on live. I have no idea. It looks like they upgraded it and didn't bother change the software and then didn't bother telling me. Finance and economics says it's pure manipulation. Yes, I agree. But people are going to trade it. They're going to try to make some profits. And Wall Street's going to lie. Jim Cramer's going to lie. It's probably why he blocked me on Twitter. Although someone probably did send him the fan art. Those were some really good Kramer clown pictures. Kramer the clown pictures. Okay, so I have a couple super chats here. Thank you for the super chat, J6, for $4.99. Thank you very much for the super chat. Another super chat from Durf Narf. Thanks for the hard work for $9.99. Thank you for the super chat for $9.99. He says, thanks for the hard work. Eventually, I will try to support you through Patreon on a monthly basis. It's much appreciated. I think I had 50 people cancel in the last 3 days. Pretty crazy. It could just be your credit or debit card company canceled. So if you didn't want to be canceled, you have to talk maybe to your credit or debit card company. That does happen, but 50 people canceling in 3 days. And I took a couple days off because I needed it. I had to disclose some of my health problems on Twitter earlier today, which is ridiculous. I shouldn't have had to disclose that, but someone was harassing me, calling me lazy. I'm doing the best I can. If I have to take an extra day or two off a week so I can feel okay, so I can get my work done, so be it. But I appreciate the kind words, Durf. He says, eventually we would try to support you through Patreon. I think I still have over 1,000 Patreon account contributors. I'm only charging $5. I think it's a pretty good deal, considering there's well over 100 pieces of unique content behind the paywall. Just in the last 6 weeks, I think there's at least 20 charts, audio, podcasts, and articles. There's a lot. According to some people, it's not enough, but I think there's a lot. Okay, Jonathan Howe, thank you for the super chat. He's also a Patreon account contributor. Are we likely to see large deflationary shock that knocks gold back below 1,000? If so, what would be a good hedge since the dollar has broken its uptrend and bonds have little to no yield? I don't know if the dollar has necessarily broken its uptrend. The dollar's been in a trading range for the last 5 years. The dollar, Brent Johnson was going to be right. What was it, March? I think it was the first week of March. It was either the first week of March or April. So the dollar index got to, I can pull it up here on the chart. The dollar index got to, I'll just pull it up here because someone's going to say, you don't know what you're talking about. You're lazy. You didn't go look at the chart. What's wrong with you? You're not an expert. You don't know what you're talking about. Okay, let me see here if I can get, where was it at 102? I have to go full screen here. This is such a pain in the ass. Okay, here we go. It was March 19th. March 19th, March 20th, the dollar index got really close to getting above 103, and it got the absolute monkey hammer on the chart. So because of that, that was definitely intervention. Because of that intervention by the U.S. Treasury and or the Fed or whoever else is acting on their behalf, Plunge Protection Team, Exchange Stabilization Fund, maybe it was all those guys. Maybe they all had to coordinate to knock the dollar index back down because things were getting out of hand that much. So Brent Johnson's scenario almost played out, but because it did not, the dollar index has been range bound for 5 years. So I would not say the dollar index has broken its uptrend. I would say the dollar index is still range bound. People are buying bonds for capital gains, not for yield. So there's still a bond bull market, but it is artificial. It is created by central banks. So I'm still trying to get the audio for James Grant from Grant's Interest Rate Observer. I did a 50-minute interview. It's really good. It's a lot of great insights into there. Unfortunately, Zoom screwed up the recording, but the Zoom technical support people tell me it is on their backup server. I'm just waiting to hear back from customer service. So hopefully I will hear back sometime this week. It was recorded last week. But what we were talking about bond vigilantes on the interview. And he says the bond vigilantes have either retired. I would also say that a lot of them are bought off because the bond traders, the bond vigilantes, the people that used to be bond vigilantes I have listened to interviews from, they don't care about the long-term health of the U.S. economy and the U.S. Treasury. They care about making profits on short-term bond trades, on leveraging up trades and front-running the Fed and making basically free, easy money. They see it as basically risk-free, basically easy, profitable trades. So there are a lot of people doing this. Also in Europe too. There's lots of professional money managers and hedge fund people and investment bankers and investment bank portfolio managers that are front-running the European Central Bank and the Federal Reserve on corporate bonds and government bonds and other toxic sausage in terms of derivatives that the central bank said they will buy. So that's why there's no bond vigilantes, because it's too profitable to just front-run the central banks and just buy what they said they're going to buy, and then they'll overpay. So they can flip it, they can leverage up a trade, flip it to the central bank, and make an easy, quick profit. Okay, back to the rest of your question. Are we likely to see deflationary shock that knocks gold back below 1,000? If gold does go below 1,000, I mean, the miners are going to be back in trouble again. It's possible we could see it, but it would be a very short amount of time. If this is why you don't buy all of your mining shares at once, this is why you have cash, in my opinion, just in case. Why you have a decent amount of cash, maybe at least 10% on the sideline in case of a scenario like this. And then maybe you have some other hedges. There's ways to protect against this. I've talked about this in articles for my patrons, like buying puts on a gold miners ETF if you think that's going to happen. I don't think that's going to happen right now because the people in power hate deflation. They will change the rules. There might be a short bout of deflation temporarily, but the politicians and the central bankers and the government bureaucrats, they hate deflation so much. Their bias is towards inflation, that they will change all the rules. They will create trillions more in currency units. They will lie, they will cheat, they will steal. They will stagflate and tax and lie to get the inflation they need, to get the stagflation they need. So if there is deflationary shock, it will be very temporary. We had deflation for 8 weeks? We had a deflation for 8 weeks where shorting stocks actually worked from mid-February through about the first week of April, and that was it. So if you were short a lot of stocks, you had maybe 8 weeks to make your profits, shorting stocks, and take your gains. And if you didn't take your gains then, you got killed. You got squeezed real bad. And unfortunately, I think there's going to be a lot more of that. There's going to be a lot more rules changes. There's going to be a lot more interventions. There's going to be a lot more emergency liquidity injections, either fiscal stimulus or whatever the central banks decide to do. I mean, how many press releases of currency swaps have they had to issue? They issued 2 currency swap press releases in a couple weeks, and the European Central Bank already had a fully outstanding currency swap line, a permanent currency swap line, according to the Federal Reserve, that was hidden in a footnote from 2013 onwards. So the European Central Bank has been on a permanent currency swap line since 2013. And that's something I found out. I wrote an article about this in the last 6 to 8 weeks. That's something I found out in 2014. And the disclosure from the Fed in one of their reports in a footnote confirmed that recently. So I don't think deflation will be allowed for a long period of time. It will be very brief. You might, if you have cash, you might have a window to buy really high quality stocks, like maybe some of those technology stocks. If they were to crash 50, 60, 70%, the really the FAANGS stocks that are way overvalued right now, maybe they go on sale temporarily. Or some of those really good oil stocks, maybe they, like a Chevron, for example, or a ConocoPhillips, or Royal Dutch Shell, maybe they crash again. There is an inflationary bias here among central bankers. They do not, we have a Ponzi scheme. The entire system, I put a tweet out about this yesterday. The entire system is essentially a Ponzi scheme. It's a fiat currency and credit Ponzi scheme. There is over 250 trillion in debt, and more debt and credit are issued, and mathematically the already existing debt and credit cannot be paid back, and yet they issue even more debt and credit. And they just try to roll over or extend or change the financing, the interest payments for the existing debts. It's a Ponzi scheme. Basically a Ponzi scheme. You won't hear that talked about on CNBC, though. I have a super chat. Let me see here. There's one more. Okay, no, there's 2 more super chats. Oh, actually 3 more. Okay. Got a super chat from Justin March. Thank you for the $5. He is also a Patreon account contributor. $5 super chat from Kavorka. For the layman, what does that mean for real estate mortgages? What happens when the banks fail? I think they're just going to print it. I don't think you're going to get your mortgage wiped. I think things are going to be fairly normal. In Argentina, during a hyperinflation, people took out mortgages thinking that the Argentinian currency would hyperinflate and their mortgages would be inflated away, and they changed the rules. So I suspect that something similar might happen if they go to a new currency, but I think Fannie and Freddie, I think they could just send it. Fannie and Freddie will back it, and the Fed will just back Fannie and Freddie. They're committed. Look, in this system, there's really nothing right now to stop them from printing trillions. There's absolutely nothing right now. There's not a good alternative to the dollar yet. So there's nothing to stop them. So I don't think any of the banks failing. I think the banks will probably get bailed out anyway. Look, there's clear problems with Wells Fargo. You can see it in the stock chart. There's clear problems with HSBC Bank. Those appear to be the 2 big banks now having the most problems. So thank you for the super chat of work. I appreciate it. So I don't think there will be banks allowed to fail like Lehman Brothers. I think they will just bail them out. They will just print it. If the shares fall enough, they'll change the rules. That's what they've been doing the last 6 months. There's been lots of rules changes. Armored Ghost says, does looting solve the cash flow problem? Not for the holders of the commercial real estate mortgages, it does not. And not for the mortgage servicers. And the mortgage servicers are liable for interest payments on the commercial real estate mortgage-backed securities. So no, the looting does not solve the cash flow problem. And if there is insurance claims, then the insurance companies are in trouble too. And the insurance companies have a lot of investments in commercial real estate and commercial mortgage-backed securities, and commercial real estate mortgage-backed securities and leveraged loans and CLOs anyway, collateralized loan obligations anyway. Okay, last question here from Son of Redemption. Super chat, thank you for the $10. Do you have any opinion on Sandstorm Gold missing their earnings? I was going to do a audio podcast on this for my Patreon account contributors. Again, I think the earnings were actually solid considering how many mines were shut down through the end of Q2. And I think it's more important to look at how they have their assets. All their assets are back online, and the mines that were offline are starting to ramp up back to full production. So yes, Q2 was not perfect, but it was also not horrible. So I would say it was solid. But overall, when you look at the company's balance sheet, if you listen to, I would listen to the conference call from Sandstorm Gold from Friday, and the conference call was actually talking about the good shape that the company's in. So even though they missed earnings and the stock's down, and by the way, it's not just Sandstorm Gold stock that's down, it's all the major royalty and streaming companies. And I think the reason is because a lot of traders are starting to take more risk. They're expecting much higher gold prices. They're expecting well over $2,000 an ounce gold, and they're starting to take more risk with their gold stock investments or speculations. So the royalty and streaming companies can still make a lot of money, but I think greed is starting to take its toll, and things are going into higher risk. I would say more greed, speculative gold stocks, and more gold miners that are higher, or silver miners that are higher cost and have more debt on their balance sheets. So some capital is leaving your Franco-Nevadas, your Wheaton Precious Metals, your Royal Golds, your Sandstorm Golds, and your Mavericks is. Well, Mavericks is not quite on the level of those other ones. But there is starting to go into maybe your Heclas, your Coeur d'Alenes, your higher cost, riskier miners. Now, I think the royalty and streaming companies will still do well, and I'll talk about this in the podcast because I think there's going to be more opportunities for more deals, maybe different types of deals than people were thinking 4 or 5, 6 months ago. I'll have to save some for the audio podcast, though. So I think overall the earnings were solid. It wasn't, considering that a lot of mines were shut down during the pandemic. A lot of the mines they're back online now. All the mines are back online for Sandstorm Gold, and there's a couple of them that were totally off for a while, and they're starting to ramp back up to full production. So they were saying Q3, Q4, sounds like the next quarters are going to be better, but most importantly, Sandstorm Gold's balance sheet is rock solid right now, and I'll talk about that in the audio podcast. Their balance sheet is in really good shape. So they have all their assets online, cash flowing, they have no debt, and they have a lot of cash on the balance sheet, and a lot more cash is coming in each month. So if the market doesn't recognize that, too bad. They'll do another deal, hopefully for more cash flow, and the valuation will keep improving. And if Sandstorm does add another deal for immediate cash flow, the valuation will probably be re-rated, because that's what's been happening with Franco-Nevada for many years now. Every time Franco adds another deal for more cash flow, or they do another deal where cash flow comes on 6 months, 12 months, 18 months, when that additional cash flow comes online, Franco-Nevada shares get a re-rating on valuation. Okay, well, I think that's it for this live stream show. I want to thank everyone for listening. The articles will be below the video in the information and description section. I have to figure out how to turn off this live stream show now with the new software, because YouTube changed it, and now there's no end live stream show button. Thanks, YouTube. Also, thank you, YouTube, for putting the default setting for 20 or 30 ads or something in my last couple of videos, and going back into prior videos that I haven't checked in weeks, if not months, and putting another 20 or 30 ads there too without me even knowing. And then I see comments below the videos accusing me of being broke and putting all the ads on there. I honestly had no idea. I saw the comments and I was like, what is going on? And then I went and looked at the last live stream show from Thursday on my smartphone, and there's like a dozen yellow dots there. I was like, I didn't put them there. What is YouTube doing? YouTube must be desperate. YouTube must need their Q3 numbers are not going to be as good. They must need that additional ad revenue to steal from their content creators. But I will try to manually now go into the current videos and try to change that. So I am perfectly happy with only 2 ads running before each interview or live stream show, and YouTube was the one who changed that. There was some really nasty trolls below the last video accusing me. It is just ridiculous. I did not turn that on.